Hey, what's up, everyone? It's great to be back. If you follow me on Instagram or you saw my little post here on YouTube, then you know that my family and I unfortunately caught that global health issue that we're always talking about. On top of that, I also had some personal issues that I was going through over the past kind of week and a half. So it's just been really difficult for me to get videos out. But I'm back now. I'm going to definitely be making more videos. And in terms of like health wise, for me personally, I am actually doing very well. So don't worry about my health. I'm just a little concerned about some of my older family members, but overall, I'm very optimistic about everything kind of going forward. And I do just want to say thank you to all of you for all of the kind words that you guys have sent my way and all of the thoughts and prayers that you've sent to me and my family. It really means a lot. I love you guys. Thank you for all the support. Okay, now with that said, I thought that a good video for my return would be to do an update on the stock market and the economy because, as you guys know, last week the stock market was basically trading at record highs, depending on what exactly you were looking at. And that's despite the fact that the economy is a complete disaster right now. So I want to talk about my thoughts on everything that's going on, how I feel about buying stocks, selling stocks, holding stocks, what I think is the best strategy here moving forward in terms of investing in this type of stock market. And I'm also going to share with you guys, of course, what I'm personally doing myself. I'm actually thinking about making a big move here in terms of selling part of one of my largest stocks. So I'm going to tell you guys about that as well. But kicking things off, I do just want to quickly start with a quick recap on the stock market and the economy and how I feel about it. And we'll just kind of go from there. Okay, so taking a look at the Dow Jones, it's still down about 10% this year. And by the way, I'm recording this on Sunday. It'll probably get posted Monday morning, so make sure you check the updated figures. But Dow Jones is quickly approaching the top there, while the S&P 500 is only down less than 6% and was actually positive just a few days ago. And then the Nasdaq is not only up this year, but it's actually broken a new all-time high just a few days ago as well, which is pretty crazy to think about. Not only are we going through one of the worst economic crises of our entire history, but the market is trading as if nothing has really happened at all. And look, I get it, the market is forward looking, but I could easily show you guys signs of the economy not only being in great despair, but that it will likely continue to see lingering effects for possibly years to come. And while I am personally more optimistic than most, what it shows me is that there is still a lot of uncertainty that just isn't getting priced into the market. But let's quickly run through those issues. Now, of course, we're still in the middle of a global health crisis, and our initial reaction of shutting everything down and destroying the economy may have ultimately been a waste, as there's still a great fear of cases spiking as we open things back up. Not to mention that people have been gathering by the thousands recently, despite there not even being a V shot available. So it'll be interesting to see if we get a big spike in cases after all of this and how the market kind of reacts to that. But either way, our decision to destroy the economy has already left us with record breaking job loss by the tens of millions that we now have to deal with. In just the past 3 months alone, we've already seen over 44 million jobs lost, a figure that makes the Great Recession look like just a minor speed bump by comparison. Now, market bulls would argue that the trajectory of jobless claims is at least downward, which clearly indicates that we've already peaked, and going forward, we should only continue to see improvements upon improvements, and therefore the market should be climbing to reflect that. But while I do actually agree with some of that logic, in fact, I've made several arguments in the past for a sharp recovery once the good news starts rolling and causes a snowball effect of continuous optimism in the market. This still seems way too fast to me, and I'll give you a couple reasons why. For one, these are just initial jobless claims, meaning that this is people basically saying, hey, I just now lost my job and I need financial help. And those numbers peaked all the way back in March. But if we look at continuing claims, meaning people that are still unemployed and receiving aid, those numbers peaked 2 months later in May and are still ridiculously high right now. And when adjusting for certain errors in the data, some economists were even predicting unemployment rates as high as around 20%, which, according to CNBC, is more than double the highest previous level we've seen, dating all the way back to the Great Depression, which, by the way, wasn't all that much higher at around 25%. Meanwhile, even the Fed is predicting the full year to end at almost 10% unemployment and even remain elevated for years to come, not even breaking south of 5% in 2022. For context, our unemployment last year was only less than 4%, and yet the market is trading as if we're in that kind of environment from last year, which we're obviously not. And like I said before, if we happen to see a big spike in cases from the global health issue, what is going to be the reaction from the federal and the local governments? What if they implement new restrictions? What if they expand already existing ones? That could end up hurting companies and their profitability, making it harder to bring back employees, which becomes a drag on the consumer, which ultimately becomes a drag on the economy going forward. And that's a big deal. Add it all up though, and I think 2020 is definitely one of the worst, most chaotic years that I think any of us have really ever seen. And yet the stock market is basically trading at levels that it was at a year ago, as if a lot of this stuff hasn't even really happened or isn't even really happening right now. Now, of course, many are arguing that the reason why is because of monetary intervention from the government and the Fed. Ever since the lockdowns, the government has implemented plans like the CARES Act that included individual checks for Americans as well as expanded unemployment payments, the Payment Protection Program that helped small businesses, and relief for some of the hardest hit industries like airlines that altogether is expected to cost close to $2 trillion, things like $1.8 trillion, making it by far the largest stimulus package in US history. And if you think that's a big number, the Federal Reserve has spent even more by purchasing debt, including even junk bonds, to ensure that companies have enough liquidity to avoid bankruptcy. And that really caused a snowball effect in the market as investors gained confidence that their companies wouldn't go bankrupt, and therefore it would only be a matter of time until things got back to normal and stocks recovered. But altogether, the Fed has increased their balance sheet by a whopping nearly $3 trillion during the crisis, reaching an all-time high of over $7 trillion in assets that they've now purchased, which resulted in them basically propping up the stock market. That's basically what happens when you do that, which, by the way, is why you always hear the saying from people, don't bet against the Fed, because they just have so much firepower to prop up the markets whenever they really want to, especially by lowering rates and figuratively printing money. That isn't to say, though, that all of this printing and spending of money won't have consequences in the future. The printing of too much money can eventually lead to catastrophic inflation, while the result of shutting everything down has led to record debt levels for not just the federal and local governments, but it's also leading to record debt for corporations, which you can see on this chart here. And in the government's case, I'm not really sure how we get out of this without having to print and inflate our way out of it, and that has a ripple effect through everything. And again, that can potentially cause an economic disaster. So debt is really what I'm personally worried about the most in terms of longer term risk for the markets and the economy. But that does also lend some credence to the idea that we probably won't see another major lockdown, kind of nationwide lockdown, even if we have a surge in cases or a spike in cases from the global health issue, which is leading to some investor confidence, because investors are basically saying, well, we can't continue to be taking on so much debt and keep spending money like this, even though we probably will. But we can't continue to do that for too much longer. So we're not going to be able to do like a nationwide lockdown again, because at some point we have to get this economy going again. At some point it just becomes too big of a disaster. We can't continue doing this. And so I think we'll continue to see businesses continue to open up and restrictions lifted and eased. But at the same time, I think we're still going to have some of those restrictions like limited capacity and social distancing rules and things like that, which do still hurt company profitability and does make it difficult for them to bring back all the employees. And so because of that, I think going forward, we will continue to see elevated levels of unemployment, at least until a V shot is released around the end of the year going into next year. And then everything kind of really starts getting back to normal at that point. But all the meanwhile, companies are still going to be taking on debt. Companies have already been taking on so much debt, and balance sheets have been deteriorating. And when you look at the stock market trading at these levels, the only stocks that are, you could even argue, are kind of attractive are the ones that have their businesses, damaged very significantly this year and have their balance sheets completely destroyed this year. Whereas all the stocks, all the companies that have actually performed well this year, despite everything going on, those are all trading at sky high prices, where during normal stock, during a normal stock market, they shouldn't be trading so high. So add it all up, and I just don't think this is a very attractive stock market. There's just not a lot of attractive stocks out there. Obviously there's always going to be exceptions and you might find some stocks here and there, but overall, just kind of in the general sense, it's just not a very attractive market. By the way, don't forget that this is still an election year, which could lead to some more volatility in the market. We really don't know how that's going to affect the market either. So there's a lot of things to consider here, just a lot of uncertainty. And so I think when you really look at all of it, we're just kind of stuck in the middle right now, this sort of kind of middle ground where I feel like the market should be trading somewhere in between the March lows and the near record highs that we're trading at right now. We should be kind of more somewhere in the middle. And right now, the market does feel a little overvalued. So, having said all of that, where do we go from here? What's the best strategy? What do we do? Well, I'm not giving you guys advice. Don't take this as advice. I'm just sharing my opinion and what I'm personally doing myself. And for me, I am taking a bit more of a neutral stance right now. See, as a long term investor, you guys know that I'm almost never a net seller of stocks. But what I do on occasion is, especially in situations like this where I feel that the market is pretty high and I'm up a lot on some of my positions, is I will actually trim some of them a little bit, kind of rebalance my portfolio and lock in some profits, especially if I could use that money to reinvest it somewhere else. And it just so happens that right now I'm actually thinking about purchasing a house for the first time ever. So I'm currently researching how to buy a house, what prices are reasonable. I'm trying to figure out where I want to live, what the neighborhoods are like. I'm doing all that research right now. So it isn't to say that I'm literally in the process of buying a house right now, but I might be soon. And so I would like to have that liquidity to put down a deposit when I do find that house that I want to purchase. So I would like to trim a little bit from maybe one of my most profitable stocks that maybe I'm a little bit too overly exposed to, that I would kind of want to rebalance anyway. And one of the stocks that fits that bill is Amazon stock, which is my second largest stock. I'm heavily exposed to it. It's over 20% of my portfolio at this point, just because the stock has been performing so well right now compared to, the rest of the market. And I wouldn't mind cashing in some profits there, not sell all of it, but cash in some profits and be able to have that money, to have that liquidity for purchasing, at least putting down a deposit on a house going forward, so I could reinvest that money. Now, I don't want to disclose the monetary value of my Amazon position, but in my Robinhood portfolio, my average cost basis is less than $1,000, whereas the stock currently trades for almost a record high of over $2,500, which is a profit for me of over 160%. So that's very large. So trimming some of that position here might make some sense for me, given that their forward PE ratio is also sky high at over 100, which is around double the amount it's been in previous quarters. And because I'm so heavily exposed to it already, trimming a little here and cashing in some huge profits would still leave me with a decent position in it. In fact, most of my most recent purchases in Amazon have been in my M1 Finance account, which holds a higher cost basis, but it's still less than $1,800, which isn't that bad. And if I was to just sell my Robinhood position and keep the M1 Finance one, that would drop Amazon from over 20% of my portfolio down to just around 10% or less, which is actually great because during this crisis, like I said, Amazon has performed very well. And I was actually looking for a reason to kind of trim it a little bit and rebalance my portfolio a little bit anyway. So I'm very comfortable with this decision, actually. And I'd like to have that liquidity. And look, I want to buy a house while I'm still relatively young, or at least be in the process of buying one, so that I have it kind of paid off by the time I'm much older. But anyway, that's on the sell side of things. So, if there's something where I could cash in some profits and I could actually reinvest that money, this is the type of market where I feel comfortable making those kind of choices. But again, that's on the sell side of things. Now, what about buying stocks? What am I doing there? Well, when looking at buying stocks, this year dividend stocks have actually performed very well for me. It's been a great play for me. I've purchased a ton of AT&T with a dividend yield of over 7% on the prices that I've paid for it. And I've also bought a lot of PepsiCo and some 3M as well. Also some dividend stocks that have great yields, and all of those dividend stocks have gigantic track records of consistently increasing their dividends every single year for literally decades. So you could throw all the volatility you want at me. You can crash the economy. You can leave us wondering what the heck is going on with this market and its valuation. And guess what? All the meanwhile, I've been collecting awesome dividends, and I will continue to collect them going forward because I've been focusing on dividend companies that have great cash flows and that have long track records of increasing their dividends every year. So it's very unlikely that they will have to cut those dividends going forward. So dividends, I think, are a solid play during this type of market environments. And then of course, whenever there's, sometimes there's just good stocks. It doesn't have to be dividend stocks. Sometimes there's just good stocks that are trading at a reasonable price. There's always, you might always run into a deal here or there. And when you do, it's important to have the liquidity to pick up those stocks. Just recently, I actually picked up some Baidu stock, not a dividend play, but just a stock that I felt was fairly valued. Picked it up at around a little over $100 a share, and I'm very comfortable with that purchase. And that was just recently. So those are the kind of things I'm doing. But in order to have the liquidity to do that, you also have to have a big cash portion of your portfolio. And because this market is not that attractive to me, a lot of my monthly budget, investing budget, has been going to my cash portion. So my cash portion continues to get bigger. And so regardless of what kind of volatility we go through, if we have any red days or we happen to have like a big correction, I will definitely have the liquidity to pick up some great stocks at some great prices no matter what happens here. So that's kind of like my three-pronged attack. So no matter what happens here, I benefit from anything going forward. If the market goes down, well, guess what? I locked in some profits already, and I've been building up a cash position to pick up stocks at good prices. If the market goes sideways, guess what? I've got dividend stocks that continue to pay me dividends even if I don't add or sell anything. And if the market goes up, well, I've still got a huge portfolio with tons of stocks, and I haven't even sold out completely out of any of my positions, not even Amazon. So no matter what happens in the market, I benefit from it because of the choices that I'm making right now with my overall strategy. So just to kind of sum everything up, I'm exercising caution. I'm locking in some profits, but not selling out completely out of anything at the moment. I'm looking for other forms of investment, like possibly a house. I'm collecting huge dividends and looking to add more to those positions when appropriate. And all the meanwhile, I am building liquidity and staying very vigilant so that I can take advantage of any opportunities that may present themselves. And of course, that's all with my long-term optimistic viewpoint on not just the stock market, but on the American economy. It's kind of my go-to strategy. But anyways, I hope you guys enjoyed the video. I hope you enjoyed hearing my opinion on everything going on and me letting you know what I'm personally doing myself. If you enjoyed the video, please hit the like button. It really helps the channel a lot. I hope this video helped you in some way. And I guess that's it. Leave your thoughts and comments down below. Let me know what you think about everything we discussed, and let me know if you're buying, selling, holding, any moves you're making, and I'll try to read and respond to as many comments as I can. But thanks again for all the support, guys. It means the world to me. I hope you're all staying safe and well out there, and I'll catch you in the next one. Take care. Bye-bye.